Your Money and Your Life is proudly brought to you by Get Credit Score, Superhero and CoinSpot.
Coming up on Your Money and Your Life, what sort of investor are you? We help you find out. How to build a great property portfolio. You are what you negotiate. Tips to secure more cash. And top stock picks from Australia's leading experts. Welcome to Your Money and Your Life, the show that helps everyday Aussies to save, invest and enjoy their money. Now, when it comes to investing, it's long been a misconception that the stock market is only for the wealthy or those who know how to trade. Well, this is simply not true and is becoming evident as the younger generation looks to the share market as an alternative to buying property. But when it comes to share investing, what sort of trader are you? And what stocks are going to suit your trading personality? Joining me now, Julia Lee from Berman Invest. Julia, good to see you.
Kochi, great to be here.
Are there really different personalities for investing in the share market?
Well, the fascinating thing about the market is that so much of it is about understanding yourself, how comfortable you are with shares, the sleep at night factor, whether you're willing to take more risk or less risk. And unfortunately, when it comes to the market, risk and return are tied together. Lower risk, lower potential return, higher risk, higher potential return. So it has to do with how comfortable you are with risk as well as how much time you have to invest.
Okay, so if you look at someone's total wealth, what percentage should be in a share portfolio?
This, I think, has to do with the stage of life, and a general rule of thumb is that your age should be the percentage of assets you have in safer assets like cash and fixed interest. For example, a 20-year-old should have 20% or less in safer assets, but an 80-year-old should have about 80% in things like cash and fixed interest. So the more time you have, the more risk that you can afford to take, whereas the less time you have, you're probably going to be more focused on capital preservation.
Okay, let's look at income investors at the moment. What should they be looking at?
Income investors love dividend yields, so it's all about getting that yield. Now, yield is tied to profit, and one of the lessons that investors have learnt the hard way is that if you're not seeing an increase in earnings, then that dividend might be at risk. So in conjunction with looking at a dividend yield, also look for a company with either stable earnings or rising earnings so that dividend is stable and it's not at risk.
Okay, lots of people look at the big banks, don't they, who cut their dividends during COVID but are now starting to bring them up again.
I mean, the banks are a great example. Banks have traditionally been very strong yielding companies. However, they're also cyclical. I think most things in life moves in cycles, and the banks certainly move in cycles. So if the economy is doing well, then earnings should be rising and dividends should be rising.
Okay, should we be in growth stocks at the moment, the ones that have big growth potential, or value stocks that just give us an all-round return?
To me, growth and value are just names we put on stocks. Most people want to return and generate a return from their portfolio. And at the core of that is understanding why share prices move. And share prices move on new information. If you think about it like buying a business, if you see new information that's positive for the business value, then the business value moves up, and if it's negative for the business value, it moves down. Let's say you're buying your local corner shop and they're going to build a huge apartment complex in record time in a month with 1,000 people moving in. That's probably going to be good for the business value. So it's all about what's already priced in and the new information that's going to move the share price up or down.
Okay, give us 3 stocks to start off a share portfolio.
I think the cornerstone to any portfolio is a bit in everything, so diversification. So if you're just starting out, I guess the holy trinity of the Aussie share market is BHP Billiton and Miner, we're the best diggers of dirt in the world, Commonwealth Bank or Macquarie Group, which is a financial company, and then CSL, something in the healthcare space. And the great thing about CSL is its research and development pipeline, which means that it's constantly got new products that it's launching.
Okay, great advice. Julia, good to see you.
Thanks, Kochi.
Thank you. Up next, building empires, how to build a property portfolio that works for you. But first, let's take a look at your credit score. When you're making financial decisions, such as applying for a personal loan or even just switching telco providers, it's important to understand the impact this may have on your credit score and how it can affect you. Did you know every time you apply for credit or a loan, it could impact your credit score? Each time you apply for credit and the creditor or lender gets a copy of your credit report, an inquiry is added. These inquiries stay on your report for 5 years and will be seen by credit providers who access your credit file. Too many applications for credit over a short time may look like you're struggling financially and can even lower your credit score. So only apply for credit that you really need and avoid applying for new loans when you're in the process of getting your finances in order, especially for a major application like a business or home loan. Knowing and understanding your credit score is an important part of staying on top of your finances. By making some positive financial changes, you'll be on the way to a healthy credit score in no time.
I'm Kylie McDonald from Morgans Financial to talk today about the importance of estate planning. It is estimated that over the next 20 years, up to $3.5 trillion will be transferred from Australians over the age of 60 to a variety of beneficiaries. Estate planning is working out the best way to structure your personal and financial affairs while you're alive and mentally sound, so you're looked after during your lifetime and your assets are distributed the way you want when you die. Some questions for you to think about. Do you have an up-to-date will? How would your family operate in the event of your disability or death? Who will look after your personal and business affairs if you lose capacity? How will your beneficiaries cope with their inheritance? Is there a risk that someone might make a claim against your estate? And are you interested in giving to charities? Estate planning is an important and everlasting gift you can give your family, and setting up a smooth inheritance is not as hard as you might think. Get in touch with a trusted financial planner today.
When it comes to investing in property, we all know what a huge financial commitment they can be. But once you get a few properties in your portfolio, the rental return can really start to work in your favour. I know it sounds great, but how do you even start to think about owning a number of properties when just one costs so much? Well, the tip is to think outside the square. Property expert Chris Gray from Your Empire Buyers Agents has been thinking outside the square all his life, and he joins us now. Chris, good to see you.
Thanks for having me.
I'm not going to ask how many properties you've got in your portfolio because I think it would scare us, but what are the fundamentals of building a property portfolio? What are the foundations?
Look, the main thing is to build a bigger asset base as possible. But the real start is basically doing the numbers and going to a mortgage broker, because they're the ones that dictate how often you can keep repeating and how much property you can buy. So get your numbers sorted with those guys, then you can work out how much you can afford, and that's when you can then start deciding, well, where can I buy in Australia?
So are most portfolios skewed towards capital growth, or should it be rental returns, or a combination of both?
Sure, so it all depends on the person. So typically high-income people will go more for capital growth because you don't pay tax on the growth, whereas lower-income people that can't afford the negative gearing will generally go for positive cash flow type properties.
So what are the types of properties you should be looking at?
We try and avoid the CBD because there's no limit of supply, and not many people want to live in a CBD. So most of the time you're going to go 5 to 15 Ks from the CBD, which is the kind of the Coogis, the Bondis, the Manleys if you're in Sydney, but they're very expensive properties, so that's more for the higher income owners. Whereas if you're going more for rental yield, you're going to go more rurally or into more regional areas.
So, Chris, the idea is to start with one, build your equity and leverage it into financing a second property and so on. So how much equity should you have in that first property before you start using it to buy another one?
So it all comes down to the mortgage broker and how much they say. So typically first homeowners will have 95 or 100%. Buying your second property, you might be 80 or 90%. And then most investors after that, then you've got to have at least 80% in there.
Okay. How do you choose the right property that will give you those rental returns?
So the main thing is go and speak to the real estate agents and the property managers to see what's in demand all the time. And they'll tell you what the local renters will want. Do they want car spaces? Do they want bigger bedrooms? Do they want outdoor space? And so it's all going to be different from Bondi Beach to then investing in the middle of Queensland. So you've got to buy the right property for that demographic in that area.
And there's so much information available to potential investors, isn't there?
So this is the balance for new people, is you want enough information so that you're not dangerous because you're spending lots of money, but you don't want too much information because then you'll procrastinate and you won't actually do anything.
Right.
So get some information. You're never going to know everything. I've done it for 30 years and I still don't know everything. So just get enough information, get in there, and then you learn more for the second one.
OK. Are there any alternatives to direct property purchases?
So a lot of people know the Airbnbs and things like that, and that can be a great way. You can get your rental returns from 5% up to maybe 10 or 12%, but it's not all perfect. So you're going to pay more money to Airbnb. It's going to be more active management, or you're going to have to pay property managers to go and do it. And just like we knew in COVID, suddenly Airbnb was banned for a while, but now it's booming. And so most of the time, for most people, I reckon it's better off to have a 12-month consistent long-term renter rather than the ups and downs of things like Airbnb. But if you're more of an active person and you want to take a bit of a risk and a bit of a punt, then sure, go and give it a go. But don't put all your eggs in one basket.
OK, give us some final tips.
Well, I think the final tips is you've got to do something, because if you don't do anything, you're never going to get anywhere. Slow and steady is the way to go, and you've got to think of decades and decades. And the next thing is just concentrate on the numbers and try and get away from the emotions. That's why I'm good at property investing, because I'm an accountant, so I've got no emotion. And that's why it makes it easier for me.
At least you can smile and you've got a sense of humour, though. All right, Chris, good to see you. Thank you for those tips. Up next, necessary negotiations, the conversations needed to get a better deal.
Hey team, Ben Nash from Pivot Wealth here, and today I'm going to cover my top 5 investment tips to build a second income. Number 1 is about choosing the right mix of growth investments like shares versus defensive investments like cash, one of the key drivers of your investment outcomes today and into the future. Number 2 is about understanding your risks so that you can manage them effectively. Things like big versus small company risk, your timeline risk, diversification, and the rest. Be aware that doing nothing also has risk attached to it. Number 3 is about choosing your investment style, active versus passive. Passive investing means just simply following the share market, whereas active investing involves trying to do better than the market itself. Choose carefully because the stats show that a big difference in the returns over the medium and long term. Number 4 is about looking ahead at your likely investment outcomes over the next 5, 10, or even 20 plus years, which will often give you a huge boost to motivation and allow you to course correct as needed. Number 5 is about taking action here. You want to push through the information overload, set your strategy, and build the confidence to take action. The first step is the hardest, but then you start building your money momentum.
Welcome back. You're watching Your Money and Your Life, the show that's all about saving, investing, and enjoying your money better. Now, in life, there are those who are born negotiators, those who can wheel and deal at work and at play, while others feel intimidated at the mere thought of approaching their boss for a pay rise or asking for a better deal on a new purchase. But help is at hand. By adapting some techniques, you too could soon be on the path to scoring that new job, getting a discount on that new car or loan, and most importantly, make a lot of extra cash. Here with some tips and tricks is your Money and Your Life reporter, Moira Geddes.
As the saying goes, in business as in life, you don't get what you deserve, you get what you negotiate. So let's start on the home front with the electricity. With the average bill in Australia ranging from $1,000 to $1,500, it's definitely worth asking for a better deal. But how? The first tip is to be prepared. Research what you're currently paying and exactly what you're getting for your money. Go to the company's website and check out their deals. Chances are you're already paying a loyalty tax for being an ongoing customer and aren't benefiting from great discounts and deals being offered to new ones. Shop around for other offers. You can do this easily by visiting any comparison website. Call them up, remembering to be calm and friendly while armed with information. Finally, be prepared to back yourself and leave them if they won't price match. Having done your homework, it's likely you'll have snagged a better deal anyway.
What you need to do is ask for a discount that's larger than the one that you want. And the one that you end up settling on ends up being just about right for both parties.
The beauty of these techniques is that they can be used for saving money on your subscriptions, health and car insurance, and even a new pay packet. Kai Mantovani admits he wasn't a born negotiator, but has learned some skills that have improved not just his confidence, but almost every facet of his life.
Salary negotiation has been one of the latest ones where I was able to renegotiate my remuneration package with my current employer.
Kai believes the secret lies in these 3 tips for a pay rise.
The first one is preparation. Get yourself prepared. Approach that conversation as if it was your interview the first time. Do your homework. Secondly, have a look at how can you solve problems and deliver value to the business. And thirdly, have some actual comparable offers if you can.
And his tips on what not to do include: don't use personal reasons for wanting the raise. Your rent may have gone up, but keep it relevant to your work performance. Be strategic around the time of your talk. Don't plan it for a Friday afternoon when the office is heading to drinks or after a liquid lunch. Don't compete with anyone else. Make the conversation about you and what you can bring to the role.
It can be really daunting becoming a good negotiator or even having your first negotiation. But if you follow those tips around believing in yourself first and foremost, you know, we can all become good negotiators. It takes some practice, but we can all become good negotiators.
Now that you're armed with knowledge, try bargaining for a better home loan rate. If you've got a good repayment history, you're more likely to get a deal. Again, it's about researching, comparing the market, and being bold enough to ask.
After the break, buy, hold or sell 2 stocks tossed around with the experts and then their call on what to do. Welcome back. You're watching Your Money and Your Life. Let's get straight into my favourite part of the show. Joining me for today's expert panel, Superhero Trading App founder John Winters and Gemma Dale from NAB Trade. Guys, how are you? Gemma, how are you seeing the market at the moment?
It's a little quiet at the moment. Quite a few of our investors have gone to the sidelines. It seems quite evident that they feel it's a bit toppy at the moment. Our cash is at record levels. It was at record levels prior to COVID when people were like, oh, I can't see anything I love. They bought like crazy last year as the market fell. It was really, really aggressive buying. Cash levels fell. They're back up again, so they're mostly sitting on the sidelines waiting for something exciting, but they're not keen to take profits either.
John, are you seeing your investors a bit quieter?
So we've actually seen net buying throughout the year. So February was a very active month for investors. The market is at record highs. It's been very strong, but we are continuing to see money flow onto the platform and a lot of people buying. Okay, let's focus on our 2 stocks for the day. First up, Kogan. John, how are you seeing Kogan at the moment? Yeah, well, Kogan's pulled back from a high of around $25. It's sitting around the $11 mark. So it's come back a long way. Revenues are up. They are saying that things are starting to normalise post-pandemic. And I don't know if that's an excuse for poor sales, but I think at these levels we are a buy. Okay. Gemma?
Our investors are the same, so we're seeing a lot of buying. Last 5 days, though, it really had to get the price right back down for them to be interested. It's never been in our top 10. It's not one of the little growth stocks that our guys really love. It's not been super popular, but obviously when that price comes right off, they've got this really contrarian bent. They like to buy things cheap. Kogan's been a buy. Below 11. They like 11 as that number. They like to sit below that.
Okay. Yes for Kogan, down at these lower levels. Gemma, let's go to a totally different sector, healthcare sector, CSL. Everyone's heard of CSL because they're making our vaccines for us, but they're a massive global company, aren't they? Australian born and bred, something to be proud of. What's the view on CSL, which has also come back?
Yeah, CSL is an extraordinary Australian company. It's quite incredible, the run that it's had over many, many decades. And we've got some investors who've ridden that whole wave. They've loved it. But it's a really small proportion. It's only about 10% of our base who hold it. They have very high conviction. They have an average holding of about $150,000, which for one stock is absolutely enormous. So we only have 2 stocks where people love it that much. Everyone else left it to the sidelines. When it fell to below 250, which is 40% off its highs, and that was really recent, so everything else has rocketed back and suddenly CSL's back at its lows. Everyone's thinking that's incredible. We saw huge buying. Around the 270, we're starting to see some profit taking again. So it's been quite interesting. The highs are at 350, so it's still so far off its highs, but it's always on a huge multiple. So we've got a lot of investors who don't want to get back up there.
Right, so a view on sort of wait for it to come back down again, do you think?
Anyone who sees it below 250 will be on it. In our base, they will be buying really
Okay.
aggressively. We've got a much bigger holding now.
Okay. John, what do you think of CSL?
Yeah, CSL is an interesting one. It does have a much higher share price. It's around that 270 mark, and that is often a detractor for younger investors. It is one of those older generation stocks as well. So it does have a monopoly position globally. It is making the vaccine, but I agree, we would need to see it come back a little bit more before we do see a rush. There's been net buying on the platform of CSL over the last few months, but I do think it would need to come back a bit more. I'd say a hold at these levels.
Okay, all right. Good to see you both, John and Gemma. Good share investing. Well, that's all we have time for this week, but for more money tips and expert advice, be sure to head to the Your Money and Your Life website. And also, if it's share advice you're looking for, you can also join me every weekday for the call, live at 12 noon on AusBiz or live on 7plus. Next week on Your Money and Your Life, cryptocurrencies. We dispel the myths and misconceptions. How to protect your wealth, assets and life, and money and matrimony. How the heartstrings can pull on the purse strings.